Let us discuss the economy page of the Indian Express for February 4, 2026. Okay, so we'll have to wait and watch impact of trade deal with US. So it is said by Economic Affairs Secretary Anuradha Thakur. Okay, a sentiment turn around, a removal of deal, uncertainty of sides. Okay, so let us understand this into details. Okay, so now you all are aware that the India and the US has recently announced signing of a deal. Okay, which is yet to be happen. Okay, officially, but they have proclaimed this on the Twitter. So see, so the belated forward movement over the India-US trade deal could have multiple macroeconomic implications for the country's economy, including a broad positive rub-off effect on account of the removal of the lingering uncertainty over the deal and a rapid turnaround in market sentiment that plays a significant role in foreign portfolio investment flows. Okay, so FPI, if you see, then in last few days, this is frequently coming in the news. I think there will be a question in the UPSC prelims on this. Okay, Economic Affairs Secretary Anuradha Thakur said, when asked about the broader macroeconomic impact of the trade deal with the US, Thakur said there are two to three things I will say. One is that it is definitely a positive development. This big uncertainty that was going around has changed. This is certainty. Did that US tariff impact the numbers hugely? No. We did not see the US India trade suddenly reach a cliff and fall. For whatever reasons, whether there was front loading of shipments from India or sectoral exemptions, it has not fallen. To that extent, the first part, removal of certainty, is great development, Thakur told the Indian Express. The second part, pertaining to how much of an impact the trade deal will have, is not known, she said. Therefore, for the impact, we will have to really see and wait for the details of what will come once Commerce and Industry Ministry shares the details with us. Thakur said. And the last part on that about market sentiment. Sentiment plays such a big role in FPI flows at least, and that has changed in the morning today Tuesday. So to that extent, it does help. Certainly there will be a positive sentiment. We have seen it in the past, we will see it again. Sentiments move very fast and impact, she added. When asked if the general impression of India changes not just in the context of stock markets or FPI flows, Thakur said that the impression has changed over time, but it was not that it was a negative impression, which is reflected in the continuing or robustness in the foreign direct investment FDI flows into India, even as the FDI flows have been volatile. When I talk to businesses, I realize whether it is for big deals or 50 small deals, they are putting their hard-earned money. The investors are actually betting on our country. So I will not say that suddenly the impression of India will change. I think the impression of India, of course, has changed over time, as we can see, but it is not that it was a negative impression, then nobody would have put in their money. We are a big market, and now we are also a home for talent where the global capability centers are coming. They are willing to put in their money because there's obviously something in it for them, she said. On the concerns regarding the capital outflows, she said FDI inflows have been firm, that capital outflows should have shown up in our FDI then. They work differently. The FDI and FVI worked pretty differently last year. The FDI investors are actually believing in the country's macroeconomic fundamentals if they are locking in equity in companies, he added. This comes in the backdrop of a slowdown in the capital inflows, inflows and a general sense of unease over increasing outflows. The Economic Survey 2025-26 had flagged capital outflows and the uncertainties on the external front as looming risk sectors for India's growth. The US announced removal of punitive tariffs on India late Monday, bringing down the headline tariff number to 18%. Headline tariff number to 18% from 50. Uh, Following this, the stock market gained sharply on Tuesday, and foreign investors returned to the market, snapping up Indian equities worth rupees 5,236.28 crore, the highest in a little over 3 months. Okay, so this is so there are few things that we need to understand from here. Okay, first thing that is the foreign portfolio investment. Then we need to also understand the causes for the capital outflows. Okay, then FDI. Okay, so for that matter, we will be using our AI. Okay, Chat GPT basically. Okay, but not now. After we will be ending with all these things. Then so now next thing is the capital interest rate to GDP growth, US agreement and India's economic outlook. So let us discuss this. So the India-US trade deal announced late Monday has brought down the tariff on Indian goods in inching the world's largest economy to 18% from 50%. And while this undoubtedly is a positive for the Indian economy, the consequences are not exactly straightforward. First things first, the reduction in tariff to 18%, which comes into force immediately, means the effective US import duty on Indian products could fall to anywhere between 12% to and 16% from 35 to 36% according to various economists. The effective tariff rate is lower than the headline a number of 18% because of the concessions the US has made on electronics, pharmaceuticals and food items such as spice, coffee and tea, and Section 232 tariffs on products like steel, aluminum, and automobiles. This economic should provide significant relief to India's export sector, especially labor intensive ones such as gems and jewelry, textiles, agricultural products, and engineering goods. The above should have several positive consequences. Higher export to the US should narrow India's merchandise trade deficit, which had surged to an all India high of $41.7 billion in October 2025 before cooling down to $25 billion in the final month of 2025. Higher exports, especially from key sectors such as textiles, should mean their job situation should, over a period of time, return to pre-August 2025 levels. The impact on economy should be meaningful, considering the U.S. is India's largest destination for merchandise exports, accounting for nearly a fifth of all shipments in value terms. As a result, all economists, including Chief Economic Advisor V. Anantha Nageswaram, expect growth forecast to be revised higher in the coming months. The Economic Survey predicted GDP growth rate to be in the range of 6.8 to 7.2% in 2026-27, down from 7.4% this year. Now, future not yet uh, crystal clear. No, yeah, yes. However, an improved growth outlook following the US tariff cut means the case for the RBI to further add to its 125 BPS worth of interest rate cuts announced in 2025 has weakened. The deal would now boost the growth certainty, certainty, and the current momentum seen in the high frequency indicators can continue to sustain. We therefore change our rate cut call of 25 bps to hold for the upcoming February 6 meeting. BOFA securities economist Rahul Bojaria and Smriti Mehra said in a note on Tuesday, adding that the RBI is now done cutting rates. The policy repo rate currently stand at 5.25%. Now, capital flows and rupee. While the impact on India's growth from the trade deal will take a while to materialize, the boost the to market sentiment has already led to tangible results. The market closed over 2% higher on Tuesday, reversing the post-budget losses due to the hike in the security transaction tax, while the rupee strengthened by more than 1% against the US dollar. The cloud of uncertainty cast by the delay in India and the US finalizing an agreement has weighed heavily on the rupee's exchange rate, which crossed the 90 and 91 per dollar levels in December 2025 and nearly 92 last week. Now, the only way seems up, at least in the started with the rupee closing strongly on Tuesday at 90.27 per dollar. I think not much important. Okay. So few things we need to just talk about the security transaction tax. Okay, then of course capital outflows, reason for capital outflow, then FPI, okay, FDI, okay, these things. Market saw 2.5% on US deal. FPIs pour in rupees 5.2 crore, sorry, 5.2 thousand crore. Okay, so you see there is a surge in the FPIs, okay, because of the USD. Okay, now I think there could be a question on the rupee depreciation. Okay, then so let us use the chat GPT. I think here we are. Yes. So let us see the foreign portfolio. Portfolio investors. Investors leaving India. Okay. So we need to understand this broad story altogether. Okay, and after this we will be understanding capital outflow. Basically, because of foreign portfolio investor going out of India, that is why capital outflow is happening. Capital is going out of India. So, so yes, here. So foreign portfolio investors are here. So, foreign portfolio investors are foreign individuals or institutions that invest in a country's financial assets like shares, bonds, mutual funds, without taking control of companies. Okay, so they are investing in a country's financial assets like shares, bonds, mutual funds, but they are not taking control of companies. Okay, example, buying Indian shares on a national stock exchange or Bombay Stock Exchange, investing in Indian government bonds, investing through mutual funds or ETFs. Okay, then they are short-term return seeking investors. Why FPI enter a country? Base logic: FPI invest where they get higher returns, stable currency, economic and political stability, liquidity, easy entry, and exit. Now, why FPI are leaving India? Key reasons. So high interest rates in the US. Okay, high interest rates in the US. Biggest reason is the high interest rates in the US. US Federal Reserve increase interest rates. Okay, US bonds now give safe and attractive returns. Uh, Now a strong US dollar. You have high valuation of Indian stock market. Then global uncertainty and risk aversion, a better opportunity. Okay, so these all are I think these are not much useful for our exam, so we will have to see it. FPI is this TIS. I think let us move to the this TIS website, because this is one of the good website I found where they provide good and good information, and that too useful for the examination. Okay, so RBI, so they have given the this CUT, that is not important for us. Okay, so here we have FPI and Forex. So this is older, but we need to just see the static part. Okay, so foreign portfolio investor. So foreign portfolio investment FPI. Investment FPI consists of securities and other financial assets passively held by foreign investors. It does not provide the investor. I think there have been lots of changes happen, so that is why we need to see it again. Okay, I hope that I will get the updated one. Okay, anyway, let us see. I think no, 7 January 2024. I'm searching somewhere 2025. No, so let us use any other website of major coaching institute. Okay, so Investopedia 5 June. So Wajiram and Ravi 6 June they have given. Okay, so I think yeah, I think we will go with Wajiram and Ravi first. Okay, so about foreign. See, this is updated one because it has been recently published last month. Okay, so this is important. See, updated material is information is important because in economics things are changing. So, what is FPI? Foreign portfolio investment. It refers to investment made by foreign entities in the financial assets of a country, such as stocks, bonds, or other securities. Unlike foreign direct investment (FDI), which involves acquiring controlling a stake in a business, FPI is more passive and typically involves a short-term investment horizon. The primary goal of FPI is capital appreciation and access to a diversified portfolio of financial assets. FPI play a crucial role in enhancing liquidity and efficiency in the financial markets, often serving as an indicator of investor confidence in a country's economic stability and growth potential. According to current FPI policy in India, a foreign portfolio investor can hold up to 10% of their shareholding in an Indian firm without being classified as a foreign direct investment FDI. Okay, now foreign institution investor FIs. So foreign institution investments are a subset of FPI and refer to investment firms or entities such as mutual funds, pension funds, insurance companies, and hedge funds that invest in a country's financial markets. While FPI includes all foreign investments in financial assets, including individual investors, FIIs especially refer to institutional investors, often involving a more strategic and structured approach compared to individual investors. Thus, while all FIs are considered FPIs, not FPIs or not all FPIs are FIs. Now, foreign portfolio investment significance, okay, capital inflow, so all these things, okay. So I think basic things we understood. Okay, let us go to the Investopedia for further understanding. So security and other financial assets held by investor in the country in another country is what is called foreign portfolio investment. Okay, so you have definition. A foreign portfolio investor involves investors holding financial assets such as stocks, bonds in other country to diversify their portfolios. Unlike direct investment, FPI generally don't confer management control over the assets. Now, so we understood this well. So foreign portfolio investment affairs consist of securities and other financial assets held by investors outside of their domestic market. It does not provide the investor with direct ownership of a company's assets and is relatively liquid depending on volatility of the market. Along with the foreign direct investment, FDI is one of the common ways to invest in overseas economy. FDI and FEI are both important sources of funding for the most economies. So how does this work? Okay. So portfolio investment involves the making and holding of hands-off or passive investment of securities, then with the exception of earning a return. In foreign portfolio investment, these securities can include stocks, American deposits ADRs, okay, receipts, global depository receipts of company. I think this much things are important, sufficient for us. Okay, for our examination perspective. Okay, so anyway, let us see if we get something from today or not. Manufacturing scheme, charging India's path, economic survey. Okay, Union Budget 26-27 economic survey. Okay, so you have lots of thing here. I think banking sector. I don't know where they have been classified. So we'll stop here. Thank you.